What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is November 29th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to unpack a massive topic. I want to do something a bit different. As many of you know, we usually talk about our generally bearish thesis and the fact that we don't believe Bitcoin is ready for a new bull market. That is still overwhelmingly our opinion, and we still stand by that. However, I want to spend some time to unpack a broader topic we've discussed as far back over the last year and a half, and that's a 10 to 20% scenario where Bitcoin can make seismic returns over the next year or so with the advent of an ETF and institutionalization of Bitcoin, and more specifically, how Bitcoin can become an asymmetric asset in a wave of heightened inflation and uncertainty in global monetary policy. We've got a lot to unpack here in today's video, and I hope that you guys will enjoy something a little bit different here on the more optimistic side. So if you do, consider dropping a like. It's a great way to support the content we put out here on this channel. And let's go ahead and kick off the rambling. Now, I know a lot of you are probably expecting me to dive right into the Bitcoin chart, but as much as I would love to do that, that is not where we need to start here when it comes to this thesis. What we need to do is turn back towards history. And we can't be looking in the days and the weeks, and when it comes to time frames, we need to be looking at months, years, and even decades and over a century to understand where this theory might come from. So what would it really take for Bitcoin to be this exponential asset, to have a major blow off top, to break not only the previous all-time highs, which again we still feel is quite unlikely now, but to be able to not only smash through those previous all-time highs at around 69,000, but go to 100K, 200K, some kind of exponential six-digit figure for one Bitcoin? Well, I think it's going to require a perfect storm. And I want to go ahead and take a look throughout history to start to demonstrate that perfect storm and what might be playing out as we speak. A lot of people generally believe that markets go up and to the right all the time, and you should always be exposed to risk-on assets or financial assets in general. But the nuance gets lost for a lot of people because they don't take a look at the details as they really are. Let me explain that. Now, a lot of people, for example, when they take a look at the long-term historical trend for the S&P 500, will note that generally, if you just take a look at the S&P 500, one of the broad measurements of stocks and assets as a whole, what you'll generally find as it's exposed to the top 500 companies is that generally things move up, sideways, or up over time. Albeit you do have some pretty big drawdowns here during recessionary periods that can scare people. They should generally be seen as buy the dip opportunities, right? Well, let me go ahead and showcase another view here. A lot of people don't measure the general stock market when it comes to inflation. And boy, will this give you an entirely different perspective on the number going up and to the right, as everyone preaches to you that simply just dollar cost average, and in a year, 2, 3, 5 years even, you'll have your money back and more. That is a lie. And we have pointed that out here in this channel for a long period of time, that it's an oversimplification of assets and how they operate in the world. There are major cyclical rotations from one asset class to another, and there are certain assets that do better than others during certain windows of time. When you measure for inflation, it gives you an entirely different picture about how the S&P 500 looks. Now, as you can see here, the number still goes up and to the right over a century's time frame. I'm not here to dispel that. What I am here to say is that if your time frame is a 5 to 10 year period, and even a year or two more specifically, you've got to be a bit more careful about expectations here. What we can see is that during the 1960s, going into the 1980s, during an inflationary wave, the real actual value when adjusted for inflation in the S&P 500 dropped from 941 points on the index down towards a point range of 347 points. To put that in perspective, from that point there in 1968, we closed enough gains, inflation adjusted, by 1982 to cut back all of the returns since 1954. That is coming up on 3 lost decades in accrued equity value increase. Think about that for a minute. I mean, think, some of us here, I know many of you watching the channel, and I don't mean it as an insult. I'm not incredibly old myself, right? The key point I want to bring up is that a lot of us haven't even lived 30 years. let alone traded in financial markets. I've traded for 12 years, and that's considered long by a lot of people here within crypto. I mean, we've never lived through something like this. You may only experience one of these types of events in your lifetime. Now, don't worry, I'm not saying here that Bitcoin is, in this theory that we're talking about today, I'm not saying that Bitcoin's going through this. What I want to say, though, is that it's not as simple as that all assets just move up and to the right. And this actually may play to the advantage for Bitcoin. Because what's going on in equity markets right now, and along with that as well, the lackluster performance in the typical risk-off hedging assets like gold, sends some signals to me that we may very well be looking for a new asset to lead. The markets may be looking for something that's not totally oversaturated, and along with that has the principal values fundamentally to be able to allow it to become this asymmetric hedging asset against everything in the world that is becoming growingly risk off, is becoming a lot more scary. And I understand people say, oh, scary things happen throughout history, but guys, we've got a lot of micro conflicts going on in the world. We've got massive supply chain disruption from what was built over the last 2 decades between China and the United States and the global economy. You've got a lot of things going on, and still sticky inflation at around 3% that's not letting up, even with the highest interest rates we've seen in over 20 years. And still, people here are still going on with the same risk-taking mindset. They just got to buy the dip. We are seeing, I think, a very clear sign that gold may not have that room to continue accelerating as an asset. Inflation adjusted here, as we can see, while gold, generally speaking, has made new highs over time. If you adjust that for inflation, we've never broken past the 1980 highs here. And this is a big point that I want to dive into here, guys, as we go throughout talking about the potential for an asset like Bitcoin. Gold itself is a sizable market. By now, gold is a multi-trillion-dollar market as an asset class. And because of that, we need to start fundamentally understanding that maybe people are going to be looking for growth elsewhere. I'll go ahead and give a great example here as we go throughout the equity plays. I know a lot of people are playing the same repetitive playbook of investing as the last decade, the last secular bull run, the great bull market of the 2010s after the 2008 recession. A lot of people are wanting to buy the strong names, and who can blame them? They are the best performers right now. A lot of people are looking to buy the FANG stocks after, again, this brutal collapse we had here between 2020 and 2022 against the NASDAQ. Now they've started to lead once again. But the problem here that I want to signify is that we still have yet to break a new high here. So this is, again, just to clarify, we're taking a look at the FANG stocks. This is Facebook, now Meta, Amazon, Netflix, Google, and we're dividing their performance as an index by the NASDAQ. Now, why am I doing this here rather than just looking at the NASDAQ or the S&P 500, right? Well, not only have the S&P 500 and the NASDAQ not broken to new all-time highs yet. That's point number one that I want to signify here. But the biggest concern to me is not so much that they haven't broken new all-time highs. That could happen eventually. The problem here is that the prior market leaders of the last decade, while people are definitely FOMOing and chasing those stocks, have not broken new relative highs with their prior highs in the past. And to be completely frank from a fundamental basis, just from like a street smart analysis, it makes sense. How is Amazon going to have the same type of growth it had in 2020? How is Google, Meta, a lot of these big tech plays, Netflix, going to do better than a period of time when everyone was forced to stay home? It was the period of peak easy money, peak speculation, and digitization of the economy through software and expansive social networks, you name it. All those major companies, how are they going to be a better growth story than they were back then? And this is the point that we've echoed for a long period of time. It's not that these stocks couldn't rebound here and recover some of their losses as they cut back on spending and lay off employees, but all those signs here are signs of a changing of the guard. Essentially, prior market leaders who led in equities are no longer leading. And I understand some of you are wondering, why am I talking about this? It's going to come back to Bitcoin, I promise. But the key thing here we need to understand is that these are the supposed market leaders here, and they're not setting new highs against the NASDAQ. So their concentration is waning over time. And you can see here as well as we just kind of take a look at the NASDAQ here, the FANG stocks. We are still far and few away from those prior highs here. And the question is, will we be able to actually expand through that? I want to just go ahead and again turn off the chart here for you guys. And I understand we had a massive correction, but does this really look to you like a healthy recovery here that's rooted in fundamentals and will just be able to continue higher here in the long run. I have to tell you guys, I don't get that feeling looking at the chart here. And I understand fundamentally that you just have to ask the simple questions beyond just analyzing price. What is Meta going to do over the next few years? What are they innovating on? What is Netflix innovating on? What is Google or Amazon innovating on that's just going to send these stocks sky high? Now, I understand some people would say AI or automation. Again, within a limited scope. Are they really going to allow for these companies to continue growing exponentially as they did over the last decade? I don't think so. We can also see here as well, there are plays like NVIDIA that a lot of people are excited about. We can see that NVIDIA is still churning higher here against the NASDAQ, albeit it started to really slow down a lot of that momentum since back here in May, as NVIDIA has started to see a PE multiple contraction from around 242 at its relative highs down now to 64 after having some pretty strong earnings reports from their purchases of GPUs from various different providers across the world. The big thing I want you guys to note here, right, as we're seeing this kind of slow down in some of these plays like Tesla, which was another growth play here in 2020, does not made any serious move against the NASDAQ and its broader performance of the other included stocks within the tech index. We haven't seen any major moves since December 2020. It's coming up on 3 years that this major EV automotive manufacturer, and also, as many people view it, Tesla is a software play, potential AI play, robotics play, this kind of, again, high growth story trading at technically, I think, 70 plus PE multiple, 76 PE multiple, absolutely ridiculous by valuation standards. This is like full on bull market euphoric territory here for a company as sizable as Tesla to be trading a 76 PE multiple, right? Even though its core business is still automotive sales. You can view it as whatever you want, but that's what generates its financials. So the question here is whether or not these names can continue to trade at these multiples and potentially even go higher, right? Because their earnings right now are waning to a large extent. You've got some oddballs here. Again, you've got NVIDIA and the AI play here, but generally speaking, there's inconsistencies in the trend, right? I don't care if you're bullish or bearish. It doesn't matter where you stand. These names aren't signaling the same kind of price confidence they were back over the last couple of years. And it doesn't look very much like they have the room to be able to triple, 4x, 5x. I mean, you can go down the list, 10x, whatever you're expecting from a kind of exponential investment class for the next decade. And then we even have Apple and Microsoft, which are the strongest players here. But you notice a very clear trend here since 2020. You can see that we had the secular bull run in the last decade. These were plays that had grown exponentially against the broader market. They swallowed market share. This is taking a look at Apple and Microsoft divided by the S&P 500. And what do you know? They've started to signal a very clear expanding funnel here. Sure, they have slightly higher lows, slightly higher highs, but you are seeing a clear deviation from that prior trend of the last decade. The markets are starting to really consider how much more these two stocks can own concentration of the broader stock market as a whole. Why am I focusing so much on market leaders? The reason why is because if you don't have new leadership, you are likely entering into a recession. You're entering into a bear market because these are the plays that have garnered the vast majority of upward valuation creation in markets, not only in their core financials, but in actual equity or market capitalization. If we do not have enough steam in these plays to continue being market leaders, and we don't have new market leaders coming in, you're likely in for a train of pain here for equities. And it's going to kill a lot of the basic, what's led to these stocks winning out over the last couple decades, or last decade or so, during the last secular bull run, is the passive investing craze into all technology plays or the broader indices. It's going to lead the NASDAQ and the S&P 500, which are heavily concentrated now, similar to the dot-com bubble and similar to prior bull market bubbles of the past, to eventually contract. And that liquidity and value can not only diminish, but sometimes it finds a new home. As that money is circulating and moving around, more actively managed funds, they're going to go out there and look for a new asset. They're going to look for something that's going to hold up well in an environment where the Fed has raised interest rates to the highest rate since back in 2001. And they're also going to be buying financial assets that might have the growth multiple potential that is something separate from traditional earnings reports or economic activity And they're going to be looking for something that might survive in a world where this federal funds rate, currently at 5.3%, is not ever going back to 0%. I want to make that very clear here, guys. This is a very important part here to Bitcoin. I know some people believe that Bitcoin is just this, like, the old saying that Bitcoin is the honey badger that doesn't care, right? Old jokes in crypto, and that there's a hodl culture and whatever. Bitcoin definitely does have some interesting dynamics to it by its investor base, but I have to tell you guys something here, that the macro does matter, especially as Bitcoin is a $750 billion asset now. And the big reason why I bring up here the federal funds rate, I know it seems boring, but I want to tell you guys that I genuinely believe that if there is some kind of recession here in the next couple months, and the Fed, pulls back interest rates to some degree, maybe they stop reducing their balance sheet, that's all expected to some degree. I could see that, but they're not dropping it to 0%. I can tell you guys that now. If I were to make a serious confident bet, I can tell you that with a high degree of confidence, it is incredibly unlikely that the Fed is going to drop to 0%. If that happens, we've got a depression on our hands. Something incredibly big has broken. There is no more risk of inflation, and we are going to be in a severe economic downturn. I don't know what that would be, but I'm just saying here that if the Fed were actually to go to that extent, because the Fed knows that if they drop to 0% interest rates, unless something significant has broken, and that is not going to be good for probably the entire financial system, may not even be good for Bitcoin, that is essentially going to be there's a reason there to bring interest rates down to 0%, and that inflation is no longer a concern. It is likely that we are going to have a modest recession, a modest pullback, and interest rates probably at the lowest point will probably go somewhere between 2 to 3%. And the reason I indicate this here is that I think we're entering in very similar, albeit in different echoes and different changes here. We're going to be repeating the 60s and the 70s. I think it's going to be a period of high inflation. You've had more than a decade here of increasing the base money supply from around like $3 to $5 trillion all the way up towards $25 trillion. We've had a decade. This is one of the only periods in history in the United States and the global economy where we've had near 0% interest rates since 2009. And we don't think that the chickens are going to come to roost. We don't think that inflation is here to stay. I think it's a foolish idea, guys. And this also leads me towards my point. The more optimistic viewpoint for Bitcoin. Could this be a catalyst? All this excess money in the system, looking for a new home, looking for an asset that might have the growth multiples, something that could essentially allow you to benefit during this expansionary period in interest rates. Well, there are two things. There's government bonds. You would have been much better buying U.S. Treasuries or many other forms of government bonds back during the 60s and 70s when inflation started to go back up. You need to look at those inflation-adjusted returns on equities. Take a look at government bonds. You'd be doing much better in that period of time because you paid a significant yield while equities were moving sideways. And sure, maybe they paid a little dividend. It wasn't enough to subside against the negative pressures of inflation that built up during that period of time. So bonds, as we've talked about in this channel, whether it's having cash in a high yield savings account or buying U.S. Treasuries of varying maturities, that can be one path forward. But I'm not saying you should go all into that. And maybe it's not of interest to you. So be it. The big thing though, the other counter asset here that I think might be able to buck the trend is Bitcoin. Now again, this is a big reason why we have not bashed dollar cost averaging, having some hedging allocation, and that's actually more the point I want to make here today. If your goal is to hedge against inflation, if that's your biggest concern, not so much to make kind of speculative returns in markets, you can easily have yourself allocated. If you've got disposable income and savings, I would put like 5-10% into Bitcoin. We've never been opposed to that here. While we've been in cash, that's always something that we've been open to, that if you want to have that hedge, so be it. But even going beyond that, right, expanding to, say, a 10 or 20% allocation in Bitcoin, that is something I wouldn't be entirely opposed to. But the big reason why we haven't been FOMOing into Bitcoin, this is a big kind of clarification point. A lot of you are probably like, Nick, okay, if you see that there's this exponential chance for Bitcoin, why are we not allocated yet? And the reason for that is because you're not going to be worrying about whether or not you got Bitcoin at the absolute lows, which practically no one did back during November 2022, at least the relative lows now, or up here at this range when it's trading at around 37, 38,000. Because if this scenario does play out, if Bitcoin does what gold did back in the day, it could have a massive move from here on out. We don't know exactly where it would go to. Everyone's guess is as good as mine here, but there is that potential chance to repeat what gold did in the past. Getting up towards a $4 trillion market cap is what happened back in the 1980s. And in alignment as well, one little thing that a lot of people haven't noticed, because it is difficult to get these statistics out there, a lot of people don't do this kind of analysis. If you look back at gold, by the estimated supply at the time times the price per ounce of gold back during 1974, before its major run-up, you started to see that essentially gold topped out at a market capitalization of around 1.2 trillion. And what do you know? Bitcoin also did that last time, back during 2021. One of the few things that as a bear, and I have the humility of saying this, I know so many people are so gun-ho in their opinions and they can't admit when something is like, ooh, maybe this makes me rethink my position. This is one of the few things that leaves me on edge thinking, maybe I need to have that allocation. Maybe I need to have that fractional allocation. Because if you have that 10, 20% allocation, and this plays out, you will hedge inflation. And you'll probably make some sizable returns as well. That all being said, while we're talking about this optimistic scenario, and I've presented this here today with you guys, I want you to heed caution, because I'm not here to spur FOMO. I'm not here to get you to buy the local top and then price just goes down, right? We still stand very strong and confident about our position that this is a unlikely scenario to play out, albeit it is a scenario to consider. And the reason I say that here is because at the end of the day, while we like to view Bitcoin as an industry, as this kind of risk-off hedging asset that would be perfect during an inflationary period of time, Bitcoin grew up in a period of time of money debasement. It grew up in a period of time of easy money. And as we bring the logarithmic chart here into play, I want you guys to consider that while this is a possibility here, and a lot of people have their sights set towards a $200,000 price tag, which is what a 500% run up from here would mean for Bitcoin, I want you guys to keep grounded in understanding that Bitcoin made exponential returns during periods of time where there was easy money. And we've never seen Bitcoin during a period of time where there's high inflation. That's not an inherently negative statement to make. Bitcoin could do well. But I have to be real with you guys that right now we don't have monetary debasement. We have inflation, right, which is a symptom of monetary debasement, of all the money printing over the last couple of years that went towards exponential crazes in 2020 and 2021. But monetary debasement, the actual printing of new money, while there might be some short-term waves and the Treasury General account, as a lot of people are citing as a sign to just go all in, go back all in, it's a new bull market, right? Well, they may be sorely mistaken, and they may be selling you an empty narrative that doesn't actually have the steam to expand by trillions and trillions of dollars over the next few years, and therefore not give the grounds in that monetary debasement to expand Bitcoin. I want to emphasize that in order for Bitcoin to be able to get to this extent, you are going to require godly amounts of liquidity for that to happen. And we are not in the same kind of high inflation environment. I will mention that while we've emphasized that inflation is sticky, you can pull up inflation metrics here. We are not in the same extent of where we were back during the 70s. And the Fed is turning towards history to hopefully make sure we don't repeat these inflationary waves. And I think the Fed has a better grip on that now than it did back during this period of time. We have something to work with here. And the Federal Reserve, again, as I emphasized earlier, don't think the Fed is going to be dropping to 0% interest rates anytime soon, unless something really bad is broken, and therefore the fight against inflation is done. You're probably going to get a temporary window of deflation. Right? So this is my point here, guys, to heed with caution on these narratives. And again, the middle kind of solution to this, like if you're on the fence, if you understand our more bearish thesis, if you also find excitement in this new kind of bullish scenario, the thing I would tell you is that, well, you can meet in the middle, have 10% exposure. And you shouldn't care about, oh, is Bitcoin 25K today, or is it 35K, or whatever price. It doesn't matter. You just have 10% allocation. You don't have to worry about dollar cost averaging it. You just get your exposure, and you wait for things to happen. It's as simple as that, guys. And I like to keep things simple here on this channel because there's so many people overcomplicating things. And I think it's important for us, as someone who remains more bearish on market sentiment, to keep open to those scenarios, to have proper hedges, because if you do have that hedge, you'll be positioned pretty well long term. You'll be able to hedge against inflation. You'll be able to benefit from those potential optimistic scenarios in Bitcoin and crypto. And if you get it wrong, you have some losses, a fractional amount of your portfolio. And maybe you had the rest of your money exposed to bonds and treasuries. Maybe you had some in cash getting in a high yield savings account. Maybe you had it in equities, which end up being the winners over the next few years. Maybe I get that entirely wrong. It's all about proper risk management. And so many people, unfortunately, are telling you that you need to be all in on something. All in on Bitcoin. Even bears who are telling you to be all in on cash, right? For me personally, that's where I feel comfortable with. I don't see the conviction here that I need to go fully into Bitcoin just yet. But if we continue smashing some of these levels and we do get an ETF, and there is the kind of inflows that could drive something like this, then yeah, I'll ride the wave as a trader. So I hope this video, if anything, proved valuable for you guys here. Above all, I know it's very difficult to navigate this environment, and it feels like in the industry that you have a lot of people who are very one-sided and polarized now. But just keep in mind that it's important to always view the other side. That's something that I always try to echo here, guys. And even though we do focus on a generally bearish thesis, understand that that comes from 12 years of experience in trading financial markets and seeing the dynamics that drive optimism. And understanding that when you don't have those, it's very unlikely that you're going to have the same type of returns long term. So anyways, I've rambled a good amount today, guys. But one thing I wanted to share with you, that as we're kind of going to closing this topic, if you guys are planning to buy Bitcoin and build this kind of exponential hedge here, one thing that I would recommend you consider, especially if you're in the United States, is to consider, if you haven't already, setting up an IRA or transitioning your IRA into a crypto and gold and silver IRA with iTrust Capital. If you guys are out there and you have a 401k or any type of retirement account out there and you're looking to garner exposure to crypto assets, look no further than iTrust Capital. I'll leave a link down below in the description. You guys will get $100 when you sign up for an account on iTrust Capital as compensation for utilizing the platform. They're the largest IRA platform in the crypto space. We've been partnered with them going as far back as 2019. And iTrust Capital as a platform, to me, is really great because it takes about the advantages of the IRA or individual retirement account, allowing you to invest in crypto with a tax deferment, essentially paying taxes later on when you actually cash out your IRA at the age of retirement at a much lower tax income rate than the rate you pay now. And outside of this, well, you're able to just simply trade in and out of cryptocurrency assets within the account, basically without having to manage taxes on an annualized basis. So it allows you to actually do what we do here on the channel, which is swing trade the cycles and be able to cash out, wait for the dip, buy back in, and you're not incurring a tax every single time you do that. So it can be incredibly advantageous for those who are even swing trading, not just long-term investing. If you guys are interested, check out the link down below in the description. They're very good about transparent pricing. They have wonderful support. I've known the team for some time, and they've got a wide range of cryptos, as you can see here. So I recommend you guys check it out down below. But that's going to be it for today's video, guys. Thank you so much for watching. As always, if you enjoyed this jam-packed episode, consider dropping a like. It's a great way to support the channel here. And until the next video, I'll see you guys in the next one. Take care, everyone.